About 500,000 small businesses are launched in Australia each year. Of those, just about half fail within 4 years. And one of the big challenges for this early stage of business is cash flow. Getting the money you've earned flowing in to meet your outgoing costs is critical if you want your business to stay afloat. So here are 5 strategies to help ensure you don't land in a cash flow crisis that could cost you your dream. In order to get paid on time, it's absolutely crucial to have a system in place that makes it easy for your customers to pay you. This can be as simple as making new customers aware of your payment terms. If you need to be paid within 14 days to keep ticking along, let your customers know from the outset. Also check that your invoicing system makes payment terms clear and lets your customers know how to pay you. For example, make sure you include bank account details or other payment options. Tools like Invoice to Go, for example, integrate with payment platforms that allow customers to pay with credit cards or via services like PayPal. Once an invoice is sent, make sure you can easily check when it's overdue and send reminders when a payment isn't received. Most businesses go through highs and lows. Some months can be particularly lucrative, while others are more challenging. Check back through your sales and expense history and look for patterns. For example, you may find there are specific times of the year when cash flow becomes tighter. That might be related to the weather or ongoing overheads, the end of the financial year, or some other factor. Once you understand what times of the year are your most lucrative and expensive, you can plan to set aside money so you're not caught short during the tighter months. Forecasting involves both planning and reviewing, so set time every month in your calendar to revise your forecast for income and expenses so that you know what's coming. There are 6 key indicators that a business may need funding. The growing pains that come with expansion, if you're turning away new business, when current funding reaches its limit, if your business isn't able to meet commitments, from putting aside funds for BAS to delivering promised stock levels, slow paying debtors and the flow-on effect that creates, and business owners using personal funds. Financing can take many different forms. There are short-term options such as overdrafts and credit cards, but high interest rates and fees can make monthly repayments significant. Small businesses have traditionally found it challenging to secure funding through established lenders such as banks. That's changing with the rise of alternative lenders like Capify that provide quick access to funds so the business can capitalize on opportunities and grow. As always, try to consolidate any multiple debts or existing loans. Weighing up the best option for your business will depend on your specific situation. That may require getting advice from an expert into what will work best for you. It can be tempting to stock up on items you need to run your business when they're on sale. The trouble is, when you invest in things like equipment, tech, or other inventory, that value is locked into something you may not be able to use for some time. So while you may be well equipped, you don't have the liquid cash. Look, if there's a special deal available, perhaps buy an extra month's supply, but don't get carried away and purchase a year's worth of items. Unexpected expenses can cripple a small business. Western Australia's Small Business Development Corporation recommends adding 20% VAT to your expense forecast and setting those funds aside, just in case you're hit with something left field, such as the need to replace a piece of important equipment, the sudden loss of a key customer, or some other unforeseen situation. You can compare business savings accounts on finder.com.au.